You're scrolling Twitter at 2 a.m. Your feed is full of the usual stuff, memes, drama, someone's vacation photos. Then you see it. A post with 40,000 views. London's silver market frozen since October. Banks on the edge of default. This is not a drill. You pause. Silver? Who cares about silver? That's boomer stuff. Gold's little brother. The metal your grandfather kept in a sock drawer. Here's what nobody's telling you. While you were watching crypto charts and arguing about AI stocks, something genuinely terrifying started happening in the oldest, most boring corner of finance. The London Bullion Market Association, LBMA. The place where the world's silver price gets set every single day. And right now, it's in backwardation. Not for a week, not for a month, 5 years forward. If that phrase means nothing to you, let me translate. Backwardation means the price to buy silver today is higher than the price to buy it in 5 years. That's backwards. Markets aren't supposed to work that way. It's like everyone suddenly deciding they'd rather have cash now than later, even though later should always be worth more because of interest. When backwardation shows up in commodities, it's a signal. Something is structurally broken. Supply is tight, really tight. And the people who are supposed to have the metal, they're scrambling. Here's the part that should make your stomach drop. Lease rates on silver just spiked to 9 to 10%. Lease rates are what it costs to borrow physical silver for a short period. Normally, they're tiny, fractions of a percent. When they jump to 10%, it means one thing. Nobody wants to lend their silver because they're terrified they won't get it back. A former JPMorgan executive went public in late 2025. His exact words? The London market has been frozen since October. New York is paralyzed. Not struggling, not under stress. Frozen, paralyzed. So how did we get here? Let's rewind. For decades, the silver market worked on a simple system. Bullion banks, the big players like JPMorgan, HSBC, Scotiabank, they acted as middlemen. Miners sell silver, investors buy silver. The banks match them up and take a tiny cut. Easy money, low risk, boring. But there was a trick built into the system. The banks didn't always have all the silver they said they had. They used something called unallocated accounts. You think you own silver. You see it on your statement. But the bank doesn't actually set aside a specific bar with your name on it. They just promise you they've got enough silver somewhere to cover everyone's claims. Most of the time, that's fine. It's like fractional reserve banking, but for metal. Except when everyone wants their metal at the same time. Then the promises start to crack. And that's exactly what's happening now. The vaults are emptying. Posts on Reddit, X, and niche finance forums are lighting up. People with industry sources, vault operators, former traders, all saying the same thing. Physical silver is being pulled out faster than it's coming in. China just banned silver exports. That's not a headline you see every day. They're hoarding. India's buying. Industrial demand for solar panels and electronics is spiking. Meanwhile, miners aren't producing enough to keep up. And the bullion banks? They're caught in the middle. They sold promises. Now they have to deliver metal. Metal they don't have. Here's where it gets darker. According to multiple sources, some of these banks are now pledging junk collateral to cover their positions. Not bars of silver, mortgage paper, derivatives. The same garbage that blew up in 2008. They're betting that nobody will actually check, that the music won't stop. But the music is stopping. And when a 5-year backwardation shows up in a market this big, that's not noise, that's a scream. Why does this matter to you? Because if the bullion banks default, if the LBMA fails to deliver physical metal, the ripple effects don't stay in some vault in London. Silver is in your phone, your car, solar panels, medical equipment. It's not just an investment. It's infrastructure. And if the price of silver explodes because the paper market collapses and everyone realizes there's not enough real metal to go around, you're going to feel it in electronics prices, in car prices, in energy costs. But here's the question nobody's asking yet. If the banks are already this desperate in early 2026, What happens when the real squeeze starts? What happens when millions of investors figure out what a handful of insiders already know?
Let's break down what's actually happening right now. Not theories, not speculation, the numbers and the structure of this crisis. First, the backwardation itself. In a normal commodity market, futures prices are higher than spot prices. That's called contango. It makes sense. If you want silver delivered in 5 years instead of today, you should pay a premium because the seller has to store it, insure it, and tie up capital. That premium usually runs about 2 to 3% per year. Right now, the spot price is higher than the 5-year forward price by a significant margin. That means traders are willing to accept less money for silver in the future just to get metal in their hands today. They're pricing in a belief that physical silver might not even be available later. This has only happened a handful of times in modern history. The last major backwardation in silver was brief, a few weeks, maybe a month. This one has been running since October 2025. We're now in January 2026. That's 3 months and counting. And it's not easing, it's deepening. Second, lease rates. Normally, if you own physical silver and someone wants to borrow it short-term, you charge them a tiny fee. Think 0.1%, 0.5%, almost nothing. It's basically free to borrow silver because there's always plenty sitting in vaults doing nothing. But lease rates just hit 9 to 10%. Let me put that in perspective. That's higher than most credit card interest rates were a decade ago. That's higher than mortgage rates in some countries right now. Why would anyone pay 10% to borrow silver for a few months? Because they have no choice. They sold silver they didn't have. They thought they could buy it later at a lower price. Classic short position. But now the price is rising and physical metal is disappearing. So they're paying insane rates just to cover their positions and avoid default. Who's paying these rates? The bullion banks. The same institutions that are supposed to be the stable backbone of the precious metals market. JPMorgan, HSBC, Scotiabank. These aren't small players. These are trillion-dollar institutions. And they're scrambling. Third, the vault situation. The LBMA vaults in London are supposed to hold hundreds of millions of ounces of silver. Nobody knows the exact number because the reporting is opaque. But industry insiders are saying the same thing over and over. Drawdowns, big drawdowns. Silver is leaving faster than it's arriving. Where's it going? Some of it's going to Asia. China banned exports, but they're importing like crazy. India's ramping up purchases. Some of it's going to industrial users who are terrified of supply chain disruptions. Some of it's going to private investors who smell blood in the water and want physical metal, not paper promises. Here's the problem. The LBMA doesn't operate like a traditional warehouse. Most of the silver in those vaults is unallocated. That means 1 bar of silver might be claimed by 3 or 4 different parties. As long as nobody asks for delivery at the same time, the system works. But when everyone starts asking for delivery, the whole thing implodes. How did we get to this point? Let's talk about the structural issues that have been building for years. Issue 1. The paper-to-physical ratio. For every ounce of physical silver that actually exists, there are estimates of 50 to 100 ounces of paper silver. Futures contracts, ETFs, derivatives, bank promises. Most of that paper will never convert to physical delivery. It's just people betting on price movements. But if even 5 or 10% of paper holders demand real metal, the system can't handle it. Issue 2. Mining output is flat. Global silver production peaked around 2015. It's been roughly flat or declining since. Why? Because most silver comes as a byproduct of copper, lead, and zinc mining. When those metals aren't profitable, silver production drops. And with energy costs rising and ore grades declining, it's not getting easier. Issue 3. Industrial demand is surging. Solar panels alone are consuming record amounts of silver. Every panel needs about 20 grams. Multiply that by millions of panels. Then add EVs, electronics, 5G infrastructure, medical devices. Silver isn't just an investment anymore. It's critical infrastructure. And unlike gold, which mostly just sits in vaults, silver gets used up, consumed, gone. Issue 4. China's export ban. China produces about 1/5 of the world's silver. In late 2025, they quietly banned exports. Not because they're trying to manipulate markets, because they need it. Their solar industry is exploding. Their domestic demand is outstripping supply. So they're keeping everything they produce inside their borders. That removes millions of ounces from global supply overnight. Now let's talk about what the banks are doing behind the scenes. According to multiple sources, including that former JPMorgan executive, Some bullion banks are now pledging mortgage-backed securities and other junk collateral to cover their silver obligations. Let that sink in. They're supposed to have silver. Instead, they have paper. The same paper that collapsed the financial system in 2008. Why are they doing this? Because they can't get physical silver. The vaults are empty. The miners can't ramp up production fast enough, and they're contractually obligated to deliver metal to clients. So they're buying time, hoping the squeeze eases, hoping something changes. But nothing is changing. In fact, it's getting worse. The New York market, the COMEX, is facing similar problems. Deliveries are delayed, premiums for physical metal are spiking. Traders are reporting that when they try to take delivery, they're being offered cash settlements instead. That's a red flag, a massive red flag. Cash settlement means the exchange is saying, we don't have your metal, so here's money instead. That might sound okay until you realize the whole point of buying silver futures is to get silver. If they can't deliver, the entire derivatives market loses credibility. Here's the really disturbing part. This isn't some fringe commodity. Silver is the second most traded precious metal in the world after gold. The LBMA and COMEX handle billions of dollars in transactions every day. If they fail to deliver, if they default, the contagion spreads to other metals, to other commodities, to the broader financial system. And here's the kicker. Most people have no idea this is happening. The mainstream financial media isn't covering it. CNBC isn't running segments on LBMA backwardation. Bloomberg isn't interviewing vault operators about drawdowns. It's flying under the radar, but it won't stay there for long. So, what happens next? There are a few scenarios, and none of them are great. Scenario 1. The banks somehow find enough physical silver to cover their positions. Maybe production ramps up. Maybe some big holder decides to sell. The squeeze eases. Life goes on. This is the best case. It's also the least likely. Scenario 2. The banks default. They can't deliver metal. They offer cash settlements. Some clients sue, others accept the cash. The paper-silver market implodes. Physical silver prices explode. The disconnect between paper and physical becomes permanent. This is the Hunt Brothers crisis all over again, but on a global scale. Scenario 3. Governments intervene. They force settlements. They change the rules. They declare force majeure, which is a fancy way of saying, sorry, we can't deliver because of circumstances beyond our control. Contracts get nullified. Investors get screwed. The system survives, but trust is shattered. Which scenario are we heading toward? Right now, all signs point to scenario 2 or 3. The backwardation isn't easing. The lease rates aren't dropping. The vaults aren't refilling. And the banks aren't talking. Does this mean you should panic? Not yet. But it does mean you should pay attention. Because when this breaks, when the defaults start happening, when the headlines finally catch up to what insiders already know, the move will be fast and brutal. And if you're holding paper silver, ETFs, or unallocated accounts, you might want to ask yourself a very simple question. Do you actually own silver, or do you just own a promise? Let's talk about what happens when markets like this actually break. Not theory. Real examples, real consequences. Case 1. The Hunt brothers, 1980. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires. In the late 1970s, they decided silver was undervalued, so they started buying. A lot. Physical metal, futures contracts. They accumulated over 100 million ounces. At one point, they controlled roughly half the world's deliverable silver supply. The price exploded. Silver went from $5 an ounce to $50 in less than 2 years. The Hunts were making billions on paper. Other investors rushed in. The squeeze was on. But then the exchanges changed the rules. They restricted futures purchases. They raised margin requirements. They made it almost impossible for the Hunts to hold their positions. On March 27, 1980, Silver Thursday, the price collapsed. The Hunts couldn't meet margin calls. They defaulted. The market crashed. Silver dropped from $50 to $11 in a matter of days. The Hunts were ruined. They declared bankruptcy. But here's the lesson. The market didn't collapse because there was too much silver. It collapsed because the exchanges changed the rules mid-game to stop the squeeze. Sound familiar? Right now, the LBMA and COMEX have the same power. If the squeeze gets too intense, if defaults start happening, they can change the rules. Force cash settlements, suspend deliveries. It's legal. It's in the fine print. And history says they'll use it if they have to. Case 2. Palladium 2000-2001. Palladium is another precious metal, used mostly in car catalytic converters. In 2000, Russia, which supplied about 2/3 of the world's palladium, quietly stopped exporting. Nobody knew why. Some said production problems. Others said the government was hoarding. The result? Panic. Lease rates spiked to over 50%. 50%. Auto manufacturers were desperate. They needed palladium for production lines. They couldn't get it. The price went from $300 an ounce to over $1,000 in less than a year. Then, just as suddenly, Russia started exporting again. The price crashed. But during that squeeze, some auto companies had to halt production. Some smaller bullion dealers went bankrupt because they'd sold metal they couldn't deliver. The system survived, but barely. Here's the parallel. Silver is like palladium in one critical way. Industrial demand is huge. If the physical market seizes up, if manufacturers can't get silver for solar panels and electronics, production stops. Prices spike. Supply chains break. And unlike palladium, which is mostly used in cars, silver is everywhere. Phones, computers, medical equipment, batteries. The ripple effects would be bigger. Case 3. Nickel on the LME 2022. This one's recent. The London Metal Exchange, March 2022. A Chinese nickel producer named Tsingshan had massive short positions in nickel futures. They'd borrowed nickel, sold it, and planned to buy it back cheaper later. But the price started rising. Fast. Russia invaded Ukraine. Sanctions hit. Nickel supply got squeezed. Tsingshan's short position turned into a nightmare. They owed billions. The price of nickel doubled in 2 days. Then it doubled again. It hit over $100,000 per ton. Tsingshan was facing a margin call they couldn't pay. Default was imminent. So the LME did something shocking. They canceled all the trades from that day, billions of dollars in transactions, just erased. Then they suspended trading for a week. When the market reopened, they'd change the rules. They gave Tsingshan time to unwind their position. Some traders who'd made huge profits on the spike got nothing. Their trades were voided. The lesson? When the big players are about to fail, the exchanges protect them. They don't protect you. They cancel trades. They suspend markets. They change margin requirements. Whatever it takes to prevent systemic collapse. Now think about silver. If JPMorgan or HSBC is on the edge of default because they can't deliver metal, do you think the LBMA will let them fail? Or will they change the rules? Suspend deliveries? Force cash settlements? History says they'll protect the banks, not the investors. Case 4. The Reddit Silver Squeeze Attempt 2021. In early 2021, right after the GameStop squeeze, a group on Reddit tried to do the same thing with silver. They encouraged people to buy physical silver and SLV, the big silver ETF. The idea was to drain physical supply and force a squeeze on the banks. The price spiked for a few days. Silver went from $25 to $30. But then it fizzled. Why? Because most people bought SLV, the paper ETF, not physical metal. And SLV doesn't have to hold all the silver it claims. It can use accounting tricks, so the squeeze never materialized. The banks didn't feel pressure. The price dropped back down. But here's what's different now. In 2021, the squeeze was artificial. Retail investors trying to force something that wasn't structurally broken. Now, in 2026, the structure itself is broken. The backwardation is real. The lease rates are real. The vault drawdowns are real. This isn't Reddit hype. This is the market screaming that something is very, very wrong. And when a real structural squeeze happens, not a manufactured one, the outcome is different. The Hunt brothers were stopped by rule changes. Palladium spiked until Russia turned the tap back on. Nickel got bailed out by the LME. But silver in 2026? There's no Russia to restart exports. There's no emergency supply. China banned exports. Mines can't ramp up fast enough. And the banks are already pledging junk collateral. What's the lesson from all these cases? First, exchanges will change the rules to protect themselves and the big players. If you're holding paper silver and the squeeze happens, don't expect fair treatment. Expect cash settlements. Expect suspended trading. Expect your contracts to be worth less than you thought. Second, physical metal behaves differently than paper. In every squeeze, the people holding physical metal came out ahead. The people holding futures and derivatives got screwed. Physical is harder to confiscate, harder to cancel. It's real. It's yours. Third, when supply squeezes happen in critical commodities, the economic damage spreads. Palladium squeezed, and car production stopped. If silver squeezes, solar panels get more expensive. Electronics get more expensive. Medical devices get more expensive. It's not just an investment story, it's an economic story. And fourth, these crises happen fast. The Hunt brothers went from billions in profits to bankruptcy in one day. Nickel doubled twice in 48 hours. When the break happens, you won't have time to react. You need to be positioned before the headlines hit. So where does that leave us now? The LBMA is in backwardation. The lease rates are at crisis levels. The vaults are emptying. The banks are pledging junk collateral. And nobody in the mainstream is talking about it yet. But they will. And when they do, when CNBC runs a segment on LBMA defaults, when Bloomberg interviews that JPMorgan executive, when the headlines finally catch up, the move will already be over. The people who studied the Hunt brothers will be ready. The people who remember palladium will be ready. The people who watched nickel will be ready. The question is, will you?
So what happens next? Let's map out the possible scenarios. Not guesses, not hopium, just the logical paths this crisis can take based on what we know right now. Scenario 1. The slow burn. The backwardation persists. Lease rates stay elevated. The banks keep scrambling, pledging whatever collateral they can find. Physical premiums keep rising. Delivery delays get longer. But no single dramatic default happens. Instead, the system slowly bleeds. Smaller bullion dealers go under first, then mid-tier banks. The big players survive by changing terms, offering cash settlements, and lobbying regulators for relief. In this scenario, silver prices grind higher over months, not days. $30, $40, maybe $50 by end of 2026. Physical metal becomes harder to source. Premiums over spot price widen to 10, 15, 20%. Industrial users start hoarding. Some solar projects get delayed because they can't secure silver. Electronics prices tick up. This is the most likely scenario if governments and exchanges successfully manage the crisis. It's painful, but contained. The system survives. Trust erodes. But there's no single catastrophic moment. Scenario 2. The cascade default. One major bullion bank fails to deliver on a large contract, maybe a sovereign wealth fund, maybe a big industrial user. The default triggers margin calls across the system. Other banks who were already stretched get hit. Within days, multiple institutions announce they can't deliver physical metal. The LBMA suspends certain contracts. COMEX does the same. The price of physical silver explodes, not gradually, violently. We're talking $50 to $100 in a week, maybe more. Paper silver, the ETFs and futures, don't follow the same trajectory because they settle in cash. The disconnect between paper and physical becomes permanent. Governments step in. Emergency meetings, possible force majeure declarations. Some contracts get voided. Lawsuits fly. Investors holding physical metal see massive gains. Investors holding paper get pennies on the dollar or tied up in legal battles for years. This scenario is less likely than the slow burn, but way more dramatic. It's the 2008 moment for precious metals. And if it happens, the contagion spreads. Gold gets hit, other commodities get hit, the entire derivatives market comes under scrutiny. Scenario 3. The intervention and reset. As the crisis deepens, governments and central banks realize the systemic risk. They can't let the bullion banks fail. So they intervene. Maybe the Federal Reserve provides emergency liquidity. Maybe the LBMA gets bailed out. Maybe new regulations get rushed through that force all derivatives to settle in cash, eliminating physical delivery entirely. In this scenario, the banks survive. But silver's role in the financial system changes forever. Physical metal decouples from paper. Two separate markets emerge. One for real metal, trading at a massive premium in private deals. One for paper contracts, tightly controlled and regulated. Industrial users get priority access to physical through government allocation programs. Retail investors get shut out or forced into paper substitutes. The price of paper silver might get capped. The price of physical silver might go to the moon, but only if you can find it, and only if you already own it. This is the controlled demolition scenario. The system doesn't collapse, it gets restructured, and the average person gets the short end of the stick. Scenario 4. The China wild card. Here's the one nobody's pricing in yet. China banned silver exports. But what if they decide to use their silver stockpile as a weapon? What if they announce they're backing some portion of the yuan with physical silver and gold? Or what if they simply keep buying every available ounce on global markets, squeezing the West even harder. China's been quietly accumulating gold for years. They don't report their silver holdings transparently. If they've been stockpiling silver too, and they suddenly reveal a strategic metals reserve, it changes everything. The West panics. Other nations start hoarding. The squeeze intensifies. Or alternatively, China could flood the market, dump their reserves to crash the price and hurt Western banks. That seems less likely given their industrial needs, but it's possible. Geopolitics and precious metals are getting tangled in ways we haven't seen since the Cold War. So which scenario happens? Probably some combination. The slow burn is already underway. We're 3 months into this backwardation. If it continues for another few months without resolution, we move toward Scenario 2. And if Scenario 2 starts happening, governments will try Scenario 3. China's the wild card. Their moves could accelerate everything or change the game entirely. What are the risks for regular people? If you're holding paper silver, ETFs, or unallocated accounts, your biggest risk is getting cash settled at a price way below what physical is trading at. You think you own silver. You own a promise, and promises can be broken. If you're holding physical silver, your risk is liquidity. When the squeeze happens, finding buyers at fair prices gets harder. Dealers might not have cash. Premiums get weird. You're rich on paper, but converting to usable currency takes time. If you ignore this entirely, your risk is inflation in critical goods. Solar panels, electronics, anything that needs silver. Those prices go up. And if the broader financial system gets hit by contagion, your risk is much bigger. Think 2008, but with a commodity crisis layered on top. What are the opportunities? If you understand what's happening before the mainstream does, you can position accordingly. Physical silver, if you can get it at reasonable premiums, is the obvious play. But it's not the only one. Silver mining stocks could explode if the metal price spikes. Companies that recycle silver from e-waste could become critical. Even understanding the supply chain disruptions lets you anticipate price moves in other sectors. The bigger opportunity is knowledge. Most investors have no idea what backwardation means. They don't know what lease rates signal. They're not watching vault inventories. If you understand the structure of this crisis, you're ahead of 99% of people, and that edge is valuable. What should you avoid? Don't chase leverage. Don't buy silver futures on margin thinking you'll time the spike perfectly. The exchanges can change the rules. They can suspend trading. They can force cash settlement. Leverage is how you go from winning to bankrupt overnight. Don't assume paper silver and physical silver will move together. In a real squeeze, they diverge. The paper price might be controlled. The physical price might go vertical. If you're betting on SLV or other ETFs, read the fine print. Understand what you actually own. Don't ignore the timing risk. This could resolve tomorrow, or it could take 2 years. Tying up all your capital in one bet, even a good bet, leaves you vulnerable. This is a serious structural problem, but markets can stay broken longer than you can stay solvent. What are the concrete steps? First, decide if you want exposure to this story. If you do, prioritize physical over paper. Coins, bars, something you can hold. Pay attention to premiums. If you're paying 30% over spot, you're already late. Second, watch the data. LBMA inventory reports, COMEX delivery stats, lease rate updates. These are all public. When the numbers start moving fast, that's your signal. Don't wait for CNBC to tell you. By then, it's too late. Third, diversify your risk. Don't put everything into silver. This is a high-conviction play for some people, but it's also speculative. If you're wrong, or if governments intervene in ways that screw investors, you don't want to be wiped out. Fourth, understand your exit strategy. If physical silver goes to $100, how do you sell? Who do you sell to? Local dealers might not have cash. Online dealers might be overwhelmed. Think through the logistics before you need them. The final point, this is bigger than silver. What's happening right now is a stress test of the entire commodity derivative system. Silver is just the canary. If the LBMA fails to deliver, if bullion banks default, the credibility of every commodity exchange comes into question. Gold, copper, oil, wheat, All of them rely on the same basic structure: paper promises backed by physical goods. If that structure breaks in silver, it can break elsewhere. And when trust in derivatives evaporates, when people stop believing that contracts will be honored, the financial system has a much bigger problem. So yes, this is about silver, but it's also about what happens when decades of financialization collide with physical reality. You can create infinite paper contracts. You can't create infinite metal. Here's the bottom line. The LBMA is in 5-year backwardation. Lease rates are at 9 to 10%. Vaults are emptying. Banks are pledging junk collateral. A former JPMorgan executive says the market is frozen. Posts with 40,000 views are calling this the start of a crisis. And it's January 2026. We're just getting started. You have a choice. You can ignore this and hope it resolves quietly, or you can pay attention. Study the data, understand the structure, position accordingly. Most people will ignore it. They'll say silver is a boomer asset. They'll say the system is too big to fail. They'll say governments will intervene and everything will be fine. Maybe they're right, but what if they're not? What if this is the Hunt brothers crisis, but global and unstoppable? What if this is the moment when paper and physical finally, permanently diverge? What if 2026 is the year the silver market breaks and takes a chunk of the financial system with it? You don't have to become a conspiracy theorist. You don't have to panic. But you should at least ask yourself one simple question. If the world's most boring, oldest commodity market is screaming that something is broken, should you be paying attention? I think the answer is yes. But don't take my word for it. Look at the data. Watch the lease rates. Track the vaults. Follow the money. And when the headlines finally catch up to what's happening in those London vaults, remember that you heard it here first. Because by the time everyone knows, the move will already be over.